wherever you are and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you informed on the latest developments in the global financial markets. And we do that by first giving you an overview of the global financial markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this year is episode number 161. And in this episode, we are reviewing the performance of the global markets during the 21st week of 2025. And that is from Monday the 19th to Friday the 23rd of May. And without further ado, this is your host, Jamuhuri, and together, let's dive right in. We kick it off in the United States, where on Friday, President Trump said he was recommending a 50% tariff on the European Union after complaining that trade negotiations had stalled. The new import tariff is expected to be operational on the 1st of June. Additionally, President Trump said that Apple will now have to pay a tariff of 25% for iPhones manufactured outside the United States. And following this announcement on Friday, shares of Apple fell by about 3%. Over to the Far East, data from the government showed that Japan's core rate of inflation accelerated to 3.5% in April, bolstered in part by rising prices of rice, which is the domestic staple, as the Bank of Japan considers pausing its rate hiking posture in order to assess the impact of US tariffs on the Japanese economy. The core rate of inflation, which strips out the prices of fresh foods, came in higher than market expectations of 3.4%, rising from 3.2% the previous month and marking the highest core rate of inflation since January 2023. Given the current trend in inflation, the Bank of Japan Governor Kazuo Ueda has signaled his intention to raise interest rates, whilst at the same time citing the need to monitor the effects of US tariffs. In the United Kingdom, according to data released by the Office for National Statistics on Wednesday, the annual rate of inflation in the UK came in at 3.5% in the month of April, which was above market expectations as economists polled by Reuters had anticipated the consumer price index at 3.3%. This latest inflation data goes against the recent trend of cooling inflation, with inflation slowing down from 2.8% in February to 2.6% in March. Meanwhile, core inflation, which excludes volatile food and energy prices, rose by 3.8% in the 12 months to April, up from 3.4% in the month of March. And in related news, a string of stronger than expected economic data signaled positive momentum for the British economy. Retail sales increased by a much better than expected 1.2% in April, whilst the Consumer Confidence Index also recorded an improvement in consumer sentiment. The combination of two positive data points contradicted market expectations, which had anticipated a slowdown in economic activity in April, mainly due to the ongoing global trade war. Staying in Europe, data from the Federal Statistical Office showed that Germany's gross domestic product, which measures the value of goods and services produced within an economy, this rose by 0.4% in the 3 months to March 2025. Germany is the largest economy in the Eurozone and is a good indicator of the economic trends in this trading bloc. On Wall Street this past week, stocks declined on Friday after President Trump escalated trade tensions by recommending a 50% tariff on the European Union and a 25% tariff on iPhones made outside the United States. President Trump said that trade discussions with the European Union were going nowhere and therefore recommended a 50% tariff on the European Union starting on the 1st of June 2025. Meanwhile, Apple shares fell by about 3% as the tech-heavy Nasdaq Composite dropped by 1% to settle at 18,737, whilst the Dow Jones Industrial Average lost 256 points on Friday to end the week at 41,603, and the broad market index, that is the S&P 500, shed about 0.6% to close at 5,802. In the government bond market, Treasury yields retreated on Friday after President Trump ramped up trade tensions with the European Union as investors dumped talks for the safety of U.S. Treasury bonds. Despite this, a sell-off in U.S. Treasuries accelerated after Moody's downgraded the United States sovereign credit rating due to concerns about its fiscal deficit and the national debt. The sell-off in U.S. Treasuries comes on the back of an exodus from U.S. financial assets and was mainly attributed to declining confidence in the U.S. economy. In response, the yield on the 2-year Treasury note was lower by less than 1 basis point at 3.99%, whilst the yield on the 10-year Treasury bond shed 4 basis points to close at 4.50%. For your information, bond yields move inversely to bond prices, and 1 basis point is equivalent to 0.01%. In the oil market, the price of crude edged higher on Friday but was set for its first weekly decline in the past 3 weeks, weighed down by rising expectations of another large increase in production. The Organization of Petroleum Exporting Countries and its allies, which includes Russia, is holding meetings next week and is expected to increase oil output by about 411,000 barrels per day in July. Reuters also reported that the group may further unwind its voluntary production cuts of 2.2 million barrels per day by the end of October this year. In response to the foregoing, both contracts were set to lose more than 1% this past week, with the price of Brent crude settling at $64.74 a barrel, whilst the price of the U.S. benchmark, that is West Texas Intermediate crude, came to a close at $61.47 per barrel. In the precious metals market, the price of gold rose more than 2% on Friday and logged its best week in the past 6 as investors sought the safe haven asset amid renewed threats of additional tariffs from President Trump. Global stocks tumbled after Trump recommended a 50% tariff on imports from the European Union and a 25% tariff on iPhones manufactured outside the United States. Gold is considered as the ultimate safe haven asset and is traditionally viewed as a hedge against inflation and economic uncertainty, and tends to perform better in a low interest rate environment since it doesn't provide a regular yield like a bond. The price of spot gold rose more than 5% this past week to hit a 2-week high of $3,362 per ounce. In the cryptocurrency market, escalating trade tensions and the recent downgrade of the U.S. sovereign credit rating has highlighted the need for an alternative store of value like Bitcoin. Bitcoin's price is being driven by a mix of positive momentum plus growing optimism around crypto regulation and increasing interest from traditional institutional investors. The divergent correlation between Bitcoin and stocks could be an indicator that investors are looking for an alternative safe haven asset away from the US dollar and gold. Bitcoin continued its rally on a Thursday, hitting a new record high of around $112,000. And according to CoinMetrics, the price of the flagship cryptocurrency is up more than 19% so far this year and was last seen trading at around $111,000 per coin. We now change scene to the Kenyan financial market, and we start by looking at the domestic foreign exchange market, where during the past week, the Kenya shilling remained static versus the US dollar, and according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.23 compared to 129.25 that was recorded the previous week. Meanwhile, the sterling pound was priced at 173.56 and the euro was valued at 146.41. And on the regional front, one Kenya shilling was changing hands for 28.27 Ugandan shillings and 20.86 Tanzanian shillings. And to the Rwandese franc, it was posted at 10.93. The Kenya shilling continues to trade within a narrow range versus the US dollar, and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenya shilling remains negative, and this is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. On foreign exchange reserves, Kenya's usable foreign exchange reserves increased by $144 million for a grand total of $10.3 billion, which is equivalent to 4.6 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this fact, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. Please note that in its weekly bulletin, the Central Bank of Kenya does not provide any explanation for the change in foreign exchange reserves. In the interbank money market, during the past week, the interbank market remained sufficiently liquid and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and credit in the interbank market. The average interbank rate, which is the rate that banks use to lend to each other, mainly on an overnight basis, this was stable at 9.87% compared to a rate of 9.85% the previous week, and was pretty much in line with the central bank rate at 10%. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio of 3.25%, this stood at 21.2 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies a percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 22nd of May, and the central bank received bids totaling to 34.1 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 142%. The central bank ended up accepting a total of 29.2 billion shillings, and the results of the auction were as follows. The 91-day rate declined by about 4 basis points to average out at 8.32%, whilst the 182-day rate dipped by less than 1 basis point to settle at 8.57%, and the 364-day rate remained unchanged for the fourth week in a row at 10% flat. Up next is our topical issue. This week we are looking at the possible listing of crypto assets at the Nairobi Securities Exchange. A Canadian-based company by the name of Valor Incorporated is in the process of submitting an application to the Capital Markets Authority seeking approval to introduce crypto asset derivatives at the Nairobi Securities Exchange. If this request is approved, this would provide Kenyan investors with an additional asset class and the opportunity to invest in crypto assets such as Bitcoin and Ethereum. The investment in crypto assets would be facilitated through an exchange-traded fund, which is a pooled investment fund that tracks the performance of an underlying asset and can be traded like shares on an exchange. This proposed investment vehicle is set to be cross-listed at the Nairobi Securities Exchange and will be regulated by the Capital Markets Authority. This particular exchange-traded fund is already cross-listed on other exchanges, including in Germany, Sweden, France, and the Netherlands. In this regard, Valor Incorporated has already appointed Gulf Corp Investment Bank, which is a fully owned subsidiary of Gulf African Bank, to act as its key transaction advisor for the cross-listing. Kenya is one of Africa's most active digital asset markets, and this initiative of the introduction of a crypto exchange-traded fund will help to widen the scope of alternative investment products and is expected to resonate deeply with the digital-savvy generation of Kenyan investors. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please share it with your family and friends and help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. For more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamuhuri@gmail.com. And Jamhuri is spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, you escape competition by becoming authentic. Think about it. Thank you, and God bless.